Well, happy Fed Day. The Fed hiked 50 basis points, 0.5% for the first time since, I guess, the 2008 tightening cycle. I can't remember exactly how many years it's been. I don't think they hiked by 50 basis points in 2008 itself. Maybe they did. But we've been living in a world of 25 basis point, i.e. quarter percentage point rate hikes for as long as I've been aware of finance, certainly, since I'm a pretty young guy. I wasn't following it too closely way back in the 05 to 08 years. And considering how much damage has been done to the stock market since the 25 basis point rate hike that we got, not too long ago, you would think, gee, well, doubling that, I mean, that's surely going to be, a disaster, right? Nope. S&P is up about 3% today, which, I mean, I wish I could make more fun of it. It actually does make some sense. The way that these things tend to work is, there's this old rule on Wall Street called buy the rumor, sell the fact, or in this case, sell the rumor, buy the fact. People front ran the Fed rate hike going all the way into this meeting. People have been shorting stocks because they knew that the 50 basis point rate hike was coming. And as soon as it finally got here, everybody covered their short positions. So that's what I see this as. The last couple of days, to me, seems like a pretty clear-cut example of a short covering rally. Now, other people might characterize it differently. There is an alternate explanation, which I'm not that fond of, that is wrapped up in this rumor that was never had much real support, but there was a rumor that was being pushed in the media of a potential 75 basis point rate hike, which would be even more disastrous than a 50 basis point rate hike. And, that seemed ridiculous to me. Why would the Fed hike 75 basis points? They've been too afraid to even hike 50 all this time. You think they're going to do a triple rate hike? I mean, this is a double rate hike is going to be risky enough for them. I could never see the Fed just right off the bat going 25 basis points to 75 basis points. Going from, in two steps, you go from 0% on the Fed funds to 0.25% on Fed funds. You've seen how much damage 0.25% on Fed funds has caused, and then you jump right to 1% on Fed funds? No, that was never going to happen. Well, Powell today got to come out and act all high and mighty and go, no, you know what? I'm going to rule out a 75 basis point rate hike. Nah, I don't think that we need that. We got this under control. To act all tough like it was ever a possibility. And to Powell's credit, he said it was pretty much never on the table to begin with, but him swatting it down was able to be, interpreted as Powell sat talking bearish. Even though his actions are, compared to his entire career as Fed chairman, this was the most hawkish day in the history of the Powell Fed. It's more hawkish than anything that Yellen or Bernanke ever did either. I shouldn't say that. I think Bernanke might have been the last guy that hiked 50 basis points. So scratch that. But he's way more hawkish than anything that Powell's ever done, and it's way more hawkish than anything that Yellen had ever done. Yellen, in her entire history as Fed chair, I believe had one 25 basis point rate hike to her name. I believe that's it. Powell hiked 25 basis points quite a few times, all the way up to like 2.25%. Then, we had the Fed flip-flop. He quit, and then he cut all the way back down to zero because of the Wu flu, supposedly. It was really to fund the government's massive deficit spending, which is now coming home to roost in the form of inflation, because the government tried to essentially replace the GDP that was lost through lockdowns by just cutting people checks and handing out PPP loans and just spending money on stupid wars and whatever else they could think of, just so on paper they could minimize the decline in GDP, even though the decline in the real economy was unquestionable. We just couldn't measure it because, the only metric that we use is this silly GDP number, which can be easily manipulated. All GDP is a measure of spending, and so if the federal government, really wants to to hide a recession, when we have a decline in the economy, all they can do is look at, okay, how much has GDP gone down? Okay, we're just going to write a check to anybody for that amount. Let's say GDP is $1 trillion a year, and it goes down to like 900 billion. And people go, oh my gosh, wow, that's a huge recession we're in. The economy just tanked 10%. Well, the federal government can just come out and write a $100 billion check and bring GDP back to even. And then people can go, look, no more recession. That's the magic of, Keynesian economics, old school Keynesian economics, not, the modern stuff that, the real modern Keynesian economists claim to believe, which I think is still nonsensical, but at least it's a little more complicated and sophisticated. The kind of stuff that is practiced by people at the Fed and in Congress, it's not very sophisticated at all. They're still using the Phillips curve. They still use all the old equations from, the general theory. And so those chickens are coming home to roost. But that's getting a little bit too much in the weeds. Today is not supposed to primarily be about inflation. Inflation's obviously part of the story here. But inflation's kind of a given, that goes into the tightening cycle itself. So beyond stocks, we know that stocks are up. And that I would attribute to a short covering rally, not a relief rally from people who seriously thought that there was going to be a 75 basis point rate hike. That's silly. We haven't had all this selling in the stock market because people thought, oh my gosh, Powell's going to hike by 75 basis points instead of 50. 50, that would be fine. We can totally handle a 50 basis point rate hike, even though we couldn't handle a 25 basis point rate hike. But 75, oh my God, that would be extreme. Yet no, I see that as a total psyop. So looking at interest rates, the Fed hiked again 50 basis points today. We're up. Interest rates are supposed to be higher today than they were yesterday. What did the bond market do? Can you take a guess? Well, I don't know what you guessed, but if you guessed yields went down, you would be correct. Bonds moved in the exact opposite direction of Fed policy. Isn't that funny? It's almost like the Fed's a bunch of clowns. And they don't have this, direct puppet master relationship that they would, like to portray. But you could also attribute this to a short covering rally. Interest rates have been rising in the bond market. The 10-year hit 3%. Hadn't been at 3% in quite some time, although 3% to me is still not high enough. If we see 4 or 5%, that's a big deal. If we get to 5%, I think that could be the end of the country. Well, we're a long way from there now. We're at 2.9 something and change. The last couple of days we were at 3%, which is a big deal to be 3% in the 10-year if we can break out above that. And you could say that the Fed coming out and making the hike official, 50 basis points, that would lead to some short covering. And so just like with stocks, I don't look at this as, something that is, necessarily crazy or unexpected, or a sign that everything's going to be just fine and that people like me have been too pessimistic and that, the Fed really does know what they're doing. No, I expect that by next week we will... Excuse me, I kicked something. I would expect that by next week we might continue the decline. Now, of course, I don't want to make concrete predictions. I don't want you to trade on that. I don't give investment advice. I don't believe in active trading. I mean, maybe some people can make a living at it if they put enough work in. It's just, to me, it's much easier to Monday morning quarterback these things and try to explain why something happened after the fact, because there are so many cross currents that go into these prices. That's how market prices work. That's why market prices are so wonderful, is that the market and the price signal is much smarter than any single one of us. And so this idea that an individual could outsmart a supercomputer is, I mean, it's It's not totally unreasonable in certain cases, but for the most part, I think it's folly. And I don't mean to come off sounding like an efficient markets, hypothesis supporter. I'm not an efficient market hypothesis supporter. Those guys think that all prices are perfect. I know. I think that prices can still be quite wrong. And in the words of Alan Greenspan, markets can remain irrational for far longer than you can remain solvent. So even though the VIX is down today, we are still in a very, very bad position. This is still a very, very volatile environment. I would not want to have my money really anywhere. I don't like having it in the bank, but I wouldn't like having it in any of these risk assets either, bonds, stocks, or real estate. And I should check again where we are with the S&P if we're close to that 20% down point, because I do still maintain that will be a pivot point for the Fed. If they choose to pivot, that could be, I think that is, where you could see it. And maybe you're starting to see it. Maybe this whole rumor about the 75 basis point hike was just a setup so that Powell could come out and deny it and, start casting out some bearish breadcrumbs. I'm sorry, did I say bearish? I think I did that earlier too. I meant dovish. I was thinking the inverse of hawkish. Also, you could take what I meant to mean, bearish on rate hikes, bearish on fighting inflation, not bearish on stock prices. The opposite. A dovish Fed would be an attempt to try and save the stock market, the bond market, the real estate market. In fact, there's an article, I have the tab open on my phone, I just haven't had time to read the article yet today in Zero Hedge, entitled, Has the Fed Already Popped the Housing Bubble? Now, I haven't read that yet. I haven't seen any indication that the Fed has popped the housing bubble, but I can hope so. And you would think that mortgage rates doubling recently would have a significant effect. I think that in certain places like, Boise, Idaho, we're seeing a popping of the bubble, but those were, I think, extreme local bubbles that were tied to, like the Wu flu lockdowns of 2020. They weren't directly attributable to the overall Fed housing bubble, which is going to be national in nature, just like it was back in 2008. There is a national housing bubble. But because of the work from home movement, there was also a bubble in a lot of these, small town type of markets that people were fleeing big cities to. And that bubble will burst as people start to transition back to, working in cities and being in office buildings, because at the end of the day, these urbanites, they like their city life. People from LA are not going to enjoy Boise, Idaho for very long. They're not going to enjoy Austin, Texas. Austin, Texas might be a big enough town for somebody like me, but if you're coming from LA or New York, I don't think there would be enough to do there. But, this is all one train. It's all heading in the same direction. Powell is the conductor, and at the end of the day, we follow his lead because we're tied at the hip. So when that train starts to derail, which I think we're definitely in the process of now, all the cars are coming off the tracks. We're all going to end up in the ditch. And so it's only, a matter of time unless Powell at some point is able to reverse this. And perhaps today, perhaps the 50 basis point hike, maybe this is peak hawkishness for the Fed. You could make that argument. Although Powell today seemed to talk like, we're going to keep up at a pace of 50 basis points at every meeting, or at least that's what we're going to consider. Every meeting we're going to consider, okay, should we hike 50 basis points at this meeting or not? And if we don't hike at this one, maybe we'll hike at the next one. And that to me sounds like they're not done hiking. Powell has not capitulated yet, and so I should have done this beforehand. But today I'm going to check. You can check too. How far down we are in percentage terms on the S&P from all-time highs. When we get to that 20% mark, which I don't believe we're at, last I checked it was only at like 12%, I think. Once we get to that 20% mark, we'll see what Powell says there. If he changes his tune, or if he stays the course. If he stays the course, you know, we could be looking at financial endgame. So, with that said, I will see you folks back here tomorrow.